The US dollar has dominated 2024 as the year's best performing currency, driven by Donald Trump's return to the White House.
Donald Trump's tariff threats seem to be working in favor of the US dollar as every country scrambles to prepare their economies for possible disruptions from Trump's presidency. The uncertainties have been very bad for most currencies around the world. The year 2025 is starting with a severe currency crisis, as major global currencies like the euro and the Chinese yuan experienced sharp declines. But Trump is not the only reason why these currencies are on a free fall. There is a lot more happening, and the situation is likely to get much worse considering the economic crisis Europe and Asia are dealing with. In all these, the US is likely to benefit in several ways. How will these countries respond, and why is gold gaining more government attention? All these will be discussed in this video. Let's take a look at this chart. It shows how major currencies around the world fared in 2024. As you can see, the US dollar gained 7.1% and is the only major currency that has gained in the past year. Every other currency is at a loss. The euro dropped by 6.2%, and most of this drop came in the last 6 months of the year. The exchange rate of the euro against the dollar has really closed up. Over in China, things are not any better. The yuan lost another 2.8% against the dollar. Forecasts hinted at further declines of up to 4%, adding to the economic anxieties of the year. The Indian rupee is at the same level as the yuan, with a loss of 2.8% too. The British pound managed to lose only 1.7%, but this is where the good news ends. All other major currencies performed a lot worse. The Japanese yen fell by 10.3%, the Russian ruble by 18.6%, while the Brazilian real dipped by 21.6%. The reason why all the major currencies are crashing is rather interesting and complex. The Eurozone faced mounting challenges that battered its currency. One of these was rising energy costs, particularly from natural gas price hikes fueled by geopolitical tensions. The cost of energy significantly increased production expenses across Europe. This, coupled with reduced demand for European exports, led to the euro's steep decline. The European Central Bank's aggressive rate cuts added to the pressure, dragging the euro-USD exchange rate closer to a 1-to-1 ratio. China's yuan faced its own problems as the nation's economic outlook looked bad. Increased import costs, along with weaker domestic growth, placed heavy pressure on the yuan. Despite interventions by the People's Bank of China to stabilize the currency, depreciation persisted. The weakening yuan further inflated the cost of imports, which worsened China's economic struggles. Energy prices have become a key factor in the current crisis, particularly in Europe. Geopolitical tensions surrounding Russian gas triggered a chain reaction, driving up costs for businesses and consumers. This economic blow not only weakened the euro, but also highlighted how deeply interconnected energy and currency markets are in today's world.
Basically, emerging market currencies are going to underperform, largely because with US exceptionalism, you have outperformance of US equities, you have a steeper curve. The number one thing the market's going to talk about now is the higher terminal rate in the US.
While these currencies struggled, the US dollar demonstrated remarkable resilience. The strength of the US economy was supported by higher productivity and robust business investment, supporting the dollar's dominance. The Federal Reserve's cautious approach to rate cuts further solidified the dollar's position. This strength offered some advantages to the US, such as cheaper imports and controlled inflation, but also strained global markets and local growth. Experts warn that if the dollar gets too strong, it would only take away from the US market.
Bad for growth and can lead to layoffs, particularly in manufacturing, which is heavily exposed to global trade.
But the most interesting reason why these currencies are crashing is because of Donald Trump's tariff threats. In recent years, the global economic landscape has been significantly influenced by the policies and pronouncements of President-elect Donald Trump's tariff threats, particularly towards China and Canada, which have led to notable devaluations of the Chinese yuan and the Canadian dollar. During Trump's tenure, he frequently accused China of unfair trade practices and threatened to impose substantial tariffs on Chinese imports. Such threats created economic uncertainty, prompting investors to move capital away from China, thereby exerting downward pressure on the yuan. Now, ahead of the continuation of his tariff campaign, the yuan has dropped to its lowest level in 16 months, nearing the 7.3 yuan per dollar mark. The People's Bank of China stepped in to stabilize the yuan by selling central bank bills in Hong Kong, a move designed to tighten offshore liquidity and curb speculative bets against the currency. However, despite these measures, the yuan's slide persisted, with forecasts predicting it could weaken further to approximately 7.5 yuan per dollar by late 2025. This depreciation brings a mixed impact. On one hand, a weaker yuan lowers the cost of Chinese exports, boosting their competitiveness on the global stage and partly mitigating the pressure from U.S. tariffs. The devaluation also reflects a deliberate strategy to counterbalance the economic strain imposed by Trump's tariff policies.
China's top policymakers are considering allowing the yuan to weaken in 2025 in the hope that cheaper Chinese exports would neutralize at least some of the impact of the 60% tariff.
On the other hand, it increased the cost of imports, contributing to domestic inflation and reducing Chinese consumers' purchasing power. The situation was further complicated by concerns over China's economic growth, low bond yields, and potential deflation, all of which contributed to the yuan's depreciation. While Trump's measures may reduce the U.S. trade deficit, which stood at $773 billion by the end of 2023, they also carry the risk of igniting a trade war with severe consequences for global markets. Trump's vision could force a realignment of global supply chains. The proposed tariffs on China might encourage some companies to relocate production to the United States or other nations, but the transition would not be without cost. Increased production expenses could drive up prices for American consumers, while retaliatory tariffs from China might limit market access for U.S. exporters. Could this isolationist approach strengthen the U.S. economy, or will it merely worsen tensions with key trading partners? For now, the U.S. appears to have an advantage, but it's important to remember that protectionist policies don't exist in a vacuum. The ripple effects of U.S. trade restrictions are already being felt by nations heavily reliant on trade with both the United States and China. For instance, Australia, whose economy depends significantly on exports to these two superpowers, has seen its currency, the Australian dollar, plunge by 9% amidst fears of a slowdown in global trade. Similarly, Trump's tariff threats toward Canada had a significant impact on the Canadian dollar. In late 2024, Trump announced plans to impose a 25% tariff on all Canadian goods entering the United States. This announcement led to a sharp decline in the loonie, which fell to its lowest level since May 2020, trading at approximately 1.44 per USD. The possibility of such tariffs created economic uncertainty, leading investors to move capital away from Canada and putting downward pressure on the Canadian dollar. Analysts predicted that if the tariffs were implemented, the Canadian dollar could depreciate further, potentially testing its pandemic-era low of 1.47 per US dollar. Most countries affected by the dollar crisis hold significant dollar-denominated debts, as they were previously attracted by low interest rates. As the dollar strengthens and the Federal Reserve maintains high interest rates, servicing these debts becomes increasingly expensive, limiting opportunities for economic growth and investment. An IMF study supports this trend. A 10% appreciation of the dollar leads to a 1.9 percentage point drop in output for emerging market economies within a year, with the negative effects persisting for up to 2.5 years. This dynamic not only stifles economic development, but also exacerbates financial risks for these countries. Adding fuel to the fire is the fact that U.S. Treasury yields remain significantly high.
As many interest rate cuts in the US this year as was previously expected, that's boosted the US Treasury yields, which in turn has boosted the US dollar.
Since mid-September, the yield on 10-year Treasuries has risen from 3.6% to 4.7%, with forecasts suggesting it could once again surpass the 5% mark. This spike in yields reflects investor concerns about persistent inflation and the U.S. government's rising fiscal deficits. Higher yields make U.S. Treasuries more attractive to global investors. In turn, this is pulling even more dollars into the U.S. economy and away from international markets. In the face of mounting dollar dominance, the BRICS nations are pushing harder to break free from the dollar-centric financial system. Their strategy revolves around creating alternatives to the dollar in global trade. Key discussions have centered on developing a shared reserve currency, potentially tied to a basket of BRICS currencies or even gold. China and Russia are leading the charge toward de-dollarization. Through the Belt and Road Initiative, China has increasingly promoted the yuan for trade settlements, while Russia has accelerated its move away from the dollar, particularly following sanctions. Both nations aim to insulate their economies from U.S. monetary policy fluctuations and Washington's geopolitical leverage via the dollar. However, establishing a credible alternative comes with significant challenges. For a BRICS currency to succeed, member nations must bridge significant gaps in economic policies, governance structures, and political priorities. Convincing global investors and trade partners of its stability remains a formidable challenge, making a unified BRICS currency more of a long-term goal than an imminent solution. In the meantime, BRICS countries are pursuing a different strategy, accumulating gold. Since 2022, gold prices have soared by 40%, hitting a record $2,600 per ounce in 2025. The surge is driven by rising inflation, geopolitical instability, and concerns over fiscal irresponsibility in economies like the US, where deficits have ballooned to $2 trillion, or 6.4% of GDP. Central banks, especially in BRICS nations, are stockpiling gold at unprecedented rates to reduce dollar reliance and create a financial safety net. China has increased its gold reserves by over 20% since 2023, and Russia has made gold a cornerstone of its financial strategy in response to Western sanctions. This gold-buying spree has drained Western markets, pushing prices to new heights. For investors, gold has reclaimed its status as a safe haven asset, echoing its historical role during financial crises. Despite these efforts, the dollar's dominance remains hard to dislodge. The global financial system, deeply intertwined with the dollar, would require a massive overhaul for any rival currency, or even gold, to take its place. Yet the shifting dynamics suggest the era of unquestioned dollar supremacy may be inching closer to its end. Yet, the signs of change are undeniable. The world's growing preference for diversification, whether in reserve assets, trade currencies, or investment strategies, signals a willingness to explore alternatives. If nothing else, this evolution shows the limitations of relying too heavily on a single currency in an increasingly multipolar world. The United States will also be facing economic problems as its financial system becomes harder to manage. One of the biggest concerns is the government running large deficits, which are expected to stay around 6 to 7% of the country's GDP each year until 2034. This is happening because the government is spending too much, paying more interest on its debt, and not collecting enough money in taxes. As a result, the national debt has grown to over $36 trillion, causing worry around the world about whether the US can keep paying its bills. The situation is risky. The US Treasury has two tough choices. It can either fail to pay its debts or print more money to cover the costs. Not paying debts was something once considered impossible, but is now a real risk if political fights or poor decisions delay action. On the other hand, printing money, while it might help in the short term, could cause high inflation or even hyperinflation. This would make the US dollar lose value and hurt the global economy. Both outcomes would create major problems for the world's financial system. Many investors are preparing for trouble, with some predicting gold prices could jump to $3,300 an ounce in 2025 as people look for safer investments. As 2025 unfolds, the global financial system finds itself at a pivotal moment. While the dollar remains the cornerstone of global trade and finance, it faces mounting pressures from shifting economic policies, geopolitical tensions, and the inherent cycles of market forces. Whether these challenges will spark a fundamental shift or ultimately bolster the dollar's dominance is still an open question. Meanwhile, the world watches closely. The BRICS nations are testing alternatives to the dollar, and gold's meteoric rise underscores a growing desire for safer assets. The persistent scarcity of dollars is driving innovation and reshaping global financial strategies. Are these developments hinting at a future less dependent on the greenback? Or will they solidify its unrivaled position? One thing is certain: the ongoing shifts in global currency dynamics and the ripple effects of dollar dominance are profoundly transforming the financial landscape. Thank you for watching. Be sure to like, subscribe, and hit the notification bell so you don't miss our next videos. See you next time.